Hello there. The second part of lecture series 15 of bite-sized corporate reporting on IFRS 13 fair value measurement will focus further on the terminologies used in the definition of fair value. Continuing from part 1 on markets, when identifying the most advantageous market, transaction costs shall be taken into account. However, no such adjustment is done when determining the fair value, as these costs are not characteristics of the asset or liability, but characteristics of the transaction. However, if location is a factor, then the market price should be adjusted for the costs incurred to transport the asset to the market. IFRS 13 does not require an entity to carry out an exhaustive search to identify either markets, but an entity should take into account all available information. An entity shall measure fair value of an asset or liability using the assumptions that market participants would use when pricing the asset or liability. Therefore, IFRS 13 assumes market participants act in their economic best interest and have the following characteristics. 1. Independent of each other, that is, the parties are unrelated. 2. Knowledgeable. And 3. Able and willing to enter into the transaction. When determining fair value, the prices to be used are those in an orderly transaction. An orderly transaction is one that assumes exposure to market for a period before the date of measurement to allow for normal marketing activities and ensure that it's not a forced sale. If the transaction is not orderly, then there will be insufficient time to create competition, and potential buyers may reduce the price they are willing to pay, with sellers forced to accept a lower price in a short period, leading to price not being representative of its true market price. IFRS 13 sets out 3 approaches an entity can use in measuring fair value. The 3 approaches are: firstly, the market approach. The market approach uses prices and other relevant information generated by market transactions for identical or similar assets, liabilities, or group of assets and liabilities. Secondly, the income approach converts future amounts, example cash flows or income and expense, to a single current amount. The fair value measurement reflects current market expectations about those future amounts. An example of income approach valuation technique is the present value model. Thirdly, the cost approach reflects the amount that would be required currently to replace the service capacity of an asset, referred to as current replacement costs. When measuring fair value, an entity should maximize the use of observable inputs and minimize the use of unobservable inputs. IFRS 13 introduces a 3-level fair value hierarchy. The final part of lecture series 15 on fair value measurement will focus on the 3-level hierarchy, fair value measurement of non-financial assets, and disclosures as set out in IFRS 13. Till then, thank you and have a pleasant day.